IPOs, initial public offerings, they have been making some headlines once again. Since the market saw a steep downturn in companies going public during 2022, the likes of Cava, Oddity Cosmetic, and Kenvue made for strong entrants that sparked investors' interest. Now, some of the most anticipated public debuts of the year are still to come, and that includes the likes of ARM, Instacart, and some might even be holding their breath for SpaceX. But it may not all be positive, with analysts arguing that the reason for increased interest is because there haven't been that many companies going public in the first place. And our next guest certainly agrees, saying that 2023 has been the worst year for IPOs since 2009. Let's bring in EquityZen head of market insight, Brianne Lynch, to discuss more. Where were you when, especially if you think back to 2009? We won't go there. But what we will think about is this current environment that we're in right now. Is ARM really the catalyst to open up the opportunity for the rest of those players that we just rattled off a moment ago?
Yeah, thanks for having me. I think ARM is one where it might not be the catalyst, but it is a company that people are going to be watching very closely. It will be the largest IPO in the US since Rivian in 2021, and it will be a good barometer for investor interest in tech and in AI specifically. Even though they're not an AI company, their real growth opportunity in the future is built around AI. And investors will really be voting whether or not they believe that that's a big enough growth opportunity for them or not.
Hey, Brianne, it's Julie here. The fact that the priced range for the shares is a bit lower than some prior estimates, what does that tell us about sort of initial demand here?
I would say that this $52 billion valuation that they're looking at right now is still a pretty aggressive valuation. It's valuing the company anywhere between 92 and 100 times price to earnings. And this is much more in line where NVIDIA and some of these companies that have kind of ridden the AI wave are trading versus some of their competitors like Qualcomm that are trading at a 15 times multiple. But really, I think investors and a lot of these corporate investors like Apple, Alphabet, Samsung, they're really betting that if their machine learning chips can become the market leaders for AI, that's where this valuation makes sense, because it certainly doesn't when you look at a company that is kind of flat, if not down on sales, and has seen their net income reduced by half year over year.
Is it as simple as believing, okay, down year in 2022, down year 2023 in the IPO market, 2024 means a huge comeback, or is that not necessarily the case here?
I think it's going to be very company specific, and there's a bit of a playbook that companies will need to align to have a successful IPO. We've seen that with Cava, Oddity, Kenvue, and some of these earlier ones. Investors are looking, it seems, for companies that are growing, at 30% plus rates, but also showing profitability. So the world of growth at all costs is no longer where we live, and companies will need to show profitability. On top of that, they need to have business models that investors can understand, or brand names that investors recognize, like Instacart. So Instacart really is checking a lot of those boxes, and I think every private company that is considering an IPO is going to need to look and see, okay, can I meet this criteria? And if not, do I raise another round in the private markets, or do I wait?
But this is not like an environment where we were looking back at, say, the dot-com bubble, where you had a bunch of companies that were looking to go public that simply, slapped on .com at the end, and they were making market entrances, and many of them kind of fell out as a result of that. This is, for what we've seen in AI, seeming like, even though there's a lot of tangible either models or chip companies or even, just different data sets that are out there, this is not like we'll see in 2024 a bunch of AI companies that'll just make a market foray or equity market debut, and investors just jump to get in early.
I don't think that will be the case because so many of these AI companies are relatively young. They're companies that have been around for 2, 3, 5 years. They're not the unicorns that have been around for 10, 15 years who are feeling both the liquidity need of early employees and shareholders, but also just ready to, put on the big boy pants and enter the public markets, and enter that phase of growth. So I don't think a lot of these AI companies are there yet. And what you're seeing with ARM is a company that's not an AI company. They're a chip company, but there is, a market opportunity for them that comes with AI. So the AI adjacency may help their story, but they're not a pure play AI company.